This ain't what you want.
Project
This ain't what you want. This ain't what you want.
Hello, people. Everybody, welcome back. So today, the thing I wanted to talk about, this is something that I was looking at for work, and I thought I would share it with you all. I don't know if I can say that this is not financial advice, or if I have to say it's not I don't know if I have to say this is not financial advice. It kind of is. I mean, if you're looking for financial advice, though, like, I have something for you to hear about. So I do not have any responsibility for any trades that do go poorly. Now, if your trade goes well, I should be given mostly full credit for it, probably. But if it doesn't work out, don't come looking at me like I did something, okay? Because I didn't. Don't yell at me. I didn't do anything, okay? I'm just telling you things that I'm noticing. So, this is what I'm noticing. Let's take a look at. We're going to look at Royal Caribbean Cruise Line, Norwegian Cruise Line, and Carnival Cruise Line, okay? And this is about shorting Norwegian Cruise Line and why that is a good idea, probably. So here's what's going on. So let's see. Carnival, we're not really going to look at that much. PE ratio for Norwegian, though, is higher than the PE ratio for Royal Caribbean. That's not the main thing that we care about here. So you want to look at their balance sheet and cash flow. And we have to compare the cash flows, the annual cash flows for these three companies. Okay, that's what we're going to do. If we look at the balance sheet for Carnival, right? Assets, liabilities, total equity, $6.8 billion. All right, that's a pretty good number. And then if we look at like that's a, let's look at that to get like a approximate at what something normal would look like. A normal amount of equity would be about $6 billion. Okay, Royal Caribbean's equity $4 billion. Okay, so it's pretty. They don't have as much money liquid, right? But that's still like quite a bit. That's a lot of money to like. It's a decent amount of equity to have, you know what I mean? So, yeah, so that's just, something to now. So that's what the equity looks like for a cruise line, theoretically, you know what I mean? We can kind of see that that's what the equity of a cruise line would look like, right? So, from there, we go to Norwegian, and we look at their equity. They have $19 billion in assets, $19 billion in liabilities. They only have $300 million in equity. Now, again, Carnival has $6 billion in equity, and Royal Caribbean has $5 billion in equity. So this is $300 million is really low. You know what I mean? That's not a big spread between 19.4 and 19.1. I don't know. If you're anything like me, this should start maybe setting off some red flags. Okay. But then it gets worse, because we go down, again, we don't really care about, because the recommendation is to pair trade shorting Norwegian for Royal. That's what we're doing over here on Lesh. Okay. So if we look for so they have like $4 billion or $5 billion in equity. If you look at their cash from financing, it's like negative $2 billion. Okay, so that means that they're paying dividends to stockholders, buying stocks back, that kind of thing, paying things off. Okay. If you look at Carnival, same thing, negative $5 billion. So they're paying more off in financing, but they are still paying off financing, right? And then if we look at Norwegian, they have a positive cash flow from financing. Okay. Which is weird. That means that that suggests that they're still taking out loans and issuing, having debt issued, right? Is that how you would say that? And that they're accruing debt right now and not paying it off. And if you look at this, they have $340 million in income from cash from financing, right? They only have $300 million in equity total. So they have more in financing than they do in equity right now. So which would suggest to me that the company is highly over leveraged and probably overvalued, right? Does that make sense? I don't really have a timeline on this. I can say that looking at Norwegians, if we want to look at like a 5-year thing here, basically like Norwegian does the worst in December is usually bad. February, March are usually bad. March is bad. You know, what else is this? July is bad. December, there we go. December's bad. November, December. So like, you know, the summer looks good, I guess. It doesn't really matter though, because like Norwegian has a major liquidity problem. It doesn't really matter. It's going downhill regardless. It also doesn't really matter because their market cap is only 8 billion compared to Carnival's, which is what is this? 20 billion, and then Royal's like 30 billion, I think. 40 billion. Yeah, so Royal's worth the most amount of money. Clearly, it's like the most expensive stock. But if we want to look at this real quick, we can see that Norwegian's right now it's doing okay, but like, you know, it's been mostly sideways over the past year as far as stock price goes. And then Royal Caribbean's been like pretty consistently up. If you look at the 200-day moving average, it's like consistently growing. This 200-day moving average is consistently like pretty much flat, as you can see. So this red line is what I'm talking about. But yeah, so that's you know, a little like this has been Finance with Lesh. Okay, it's been a fun segment, and now we're gonna get back into regularly scheduled programming, talking about Karl Marx mathematical manuscripts. Thank you for watching, everybody. Please like and subscribe. And if you like this video, let me know so I can do more of these things. But yeah, I thought it was kind of interesting. Hope you enjoyed. Leave a like, leave a comment, and talk to you all soon. Thanks. Bye.